Hello again, traders, and welcome back to the Pro Trader Network. This is part 3 of our series discussing market structure. And in this video, we're going to discuss trends. Well, are trends part of market structure? Well, yes, they are. They're actually created by the swing highs and lows of price. And if we know the market is trending, we can take advantage of multiple opportunities to profit during such trends. The question we have to ask ourselves is, what defines a trend and how do we recognize it? Well, as I mentioned, traders, the trend can be a powerful addition to our trade plan and trading system. We know that trends create multiple profit opportunities in the market, and that the trend is actually a result of the collective emotion of all traders in the market believing that price should continue in one direction, either continue to sell off or continue to rally. Well, how do we recognize a trend? We have to define it and then apply that definition to determine if indeed a trend is present. The classic definition for an uptrend is a series of higher highs and higher lows. The classic definition of a downtrend is a series of lower highs and lower lows. And if we decide to incorporate trend recognition as part of our trade plan and trade system, we can make changes to that definition to further specify and create a rule as part of our trade plan. And these swing highs and swing lows that we're referring to, traders, really are just our old friends support and resistance. And we know from previous videos on market structure, these are the dynamic swings that take place in the market where price is being tested and retested over and over again. One of the things I like to use is a type of trend line indicator so that I can take a look at the trend at a glance. I like to take a look at that trend line on my higher time frame so I can quickly and easily correlate my trading time frame to make sure I am indeed trading with the trend on the higher time frame. If you do intend to be a trend trader, you have to ask yourself, what type of trend line or indicator should we use? And as I said, for better visual acuity, for me, I prefer an adaptive EMA. That's an exponential moving average. And the one that you see in my videos is one that actually changes color when the trend changes. And traders, I make that color change along with some behaviors in price part of my rule set. Traders, there are other ways to draw trend lines, typically from swing to swing, connecting tops and bottoms. Some are specifically defined. If you're familiar with the work of Tom DeMark in his book, The New Science of Technical Analysis, he spends quite a bit of time actually defining a valid trend line. He calls his supply and demand lines. It's a very interesting read. And actually, one of the professional traders I encountered early in my trading career suggested to me that I buy Tom DeMark's book and read chapter 100 times regarding his definition of what constitutes a valid trend line. And others are just loosely applied depending on how specific we want to be and what we're looking for on our charts. The other thing we can do is just simply look at price. We can zoom out on our charts, get a feel for new structure highs and lows, sore thumb highs and lows, and we can easily and quickly determine if indeed the market is trending. What we're trying to do here, though, traders, is whether we are trend traders or counter trend traders, we need to be able to identify if the market is trending or consolidating. It's a widely held belief that you have to have a strategy for trend trading as well as a separate strategy for consolidation trading or range market trading. What I simply do is drill down to the smaller time frames when the higher time frames are ranging, and you'll find that within a higher time frame range, the smaller time frames can exhibit trending. Another thing you hear commonly as well, traders, is that the market only trends 30% of the time. So if you're a trend trader, back to my previous comment, you might want to have multiple strategies where you can trade in higher time frame ranges, perhaps drill down to the smaller time frames. And I'd like to emphasize, traders, that if you are a trend trader, you are going to have to be patient. That will be a big part of your trading strategy, being prepared to take advantage of the trend, and then, of course, sitting out when the market's consolidating. I'm going to pull in my chart right now, traders, and we'll take a look at some different types of trend lines as well as the strategy I use for my exponential moving average. All right, traders, this is my Euro-Dollar weekly chart. And if I was to ask you, are we in an uptrend or a downtrend, what would you say? I can simply look at my trend line, traders, on my price chart and say if the line is black, then price is in a downtrend. If the line is gray, then price is in an uptrend. So let me pull my cursor down. If price is above my trend line, we're in an uptrend. And there we have an uptrend. If price is below my trend line, we're in a downtrend. If price is above, an uptrend, below, downtrend, uptrend, downtrend, downtrend, downtrend. Well, for some of you, that may seem kind of arbitrary. In a series of higher highs in our previous definition, we have higher high, higher high, higher high, higher low, higher low, higher low. So when did this downtrend right here turn into an uptrend? Well, I've defined my definition more specifically to say when price breaks above and closes above my trend line, I am now in an uptrend. And that break above and close above is what I call a rotation. That rotation is either going to be a break above and close above my trend line, or a break below and close below my trend line. So as far as my definition of a trend, right here on this particular candle on this weekly chart, when price broke above and closed above my 89 exponential moving average, that for me defines a new uptrend, and that is called a bullish rotation. Right here, when price broke below and closed below my trend line, and my trend line turned black, that constitutes for me a change in the trend, and that is a bearish rotation. So on my videos, when I refer to a bullish rotation, it means that price has broken above and closed above my trend line, and for my rule set traders, that defines a change in the trend. But as you know, I do look at the higher time frames and then trade on a lower trading time frame, especially intraday. Let's take a look at a daily chart. All right, traders, here's our daily chart. And if I look at this chart, I can see that the market is in a downtrend. How do I know that? Let me pull my cursor down. Not only is my exponential moving average black, but it's also pointing down. And notice what happens when my exponential moving average is flat. Even though the market has these rotations, even though I have a bull rotation, bear rotation, bull rotation, bear rotation, my trend line is flat. And look at the market. It's in a consolidation phase. Well, why is that important? Because if I'm trading on the daily time frame and I know that my weekly time frame is clearly in a downtrend, I would be looking to take only sells on the bear rotations. I would be a seller only. Back to the last video on higher time frames. This is how we distinguish which direction we are going to trade when using multiple time frames. We try to be congruent with the direction of our higher time frames. That way, if there is this head fake here, this bounce up, and I'm in a short position, unless my higher time frame is showing divergence, I don't have to panic because I still know that I'm trading with the overall direction of my higher time frame, which on the weekly was a downtrend. I'm going to mark this particular candle right here, and let's take a look at where that shows up. Let's go back to our weekly chart. You can see that particular candle shows up right here on our weekly chart. Clearly, our 89 EMA, our trend line, is heading downward, and we are in a downward trend. So there's no reason for me to panic if I'm drawn down on that daily trade, because I know that overall I'm still in a downtrend. And then determining stops and targets, traders, will also be a part of that trade plan. We know that, and I can determine that using Fibonacci's and previous market structure. But I'm just saying to you, the overall mindset when I look at this chart is I'm a seller only. So if I'm a seller only and I get a signal on my daily chart, let's go back to our daily chart. Here's our signal. If I'm a seller only, do I take this buy signal? Well, not based on the rule set I just outlined. I'm only looking for sell trades because my higher time frame is in a downtrend. So anytime I get a sell signal, I'm trading with the trend of my higher time frame, which is bearish. Let's go back to our weekly chart again. When did this bearish downtrend begin? Well, it started, as far as my rules are defined, right here. And then guess what? We had a bullish rotation, and then we had a continuation of that downtrend right here on this bearish rotation. And it's very important to me, traders, that you do not overthink this or do not get confused. I look at my top-down analysis. I have very specific rules for trading with a trend and trading counter trend. And it really begins with, how do I start the day? Am I a buyer or a seller on each pair in my portfolio? And that's what top-down analysis does for me. When I start my day, I run through my quick top-down on every pair. As we know, that should only take between 5 and 8 minutes, starting with the daily chart. I'm using weekly here because it's easier for me to get more price action on my chart, but I like to start with the daily chart and run all the way down to the 15-minute. The most frequent question I get asked is, what if your trading time frame is in conflict with your higher time frame analysis? Well, you always stick with your trading time frame, but if you know you're trading against the trend of your higher time frame, you have to have in your trade plan position sizing, stops, and target adjustments to compensate for the fact that you're trading against the trend. And any good trade plan has those adjustments, traders, built in. If you've done your back testing, you can take a look at trades where you are trading counter trend, you have a specific rule set, and you need to be cognizant of the fact that you are trading against the higher time frame. You've seen my trading videos where I actually confirm a candle pattern counter trend on the higher time frame and then simply look for entries on the lower time frame. You'll notice that on the lower time frames, my rotation takes place, my trend change takes place sooner than on the higher time frame. I'm just simply looking for the trade really to play out on the smaller time frames, confirmed by my rule set on the higher time frame. Traders, it is ultimately my goal to make this as simple as possible, but you need to understand some of these elemental concepts in trading, and that is a bearish and bullish rotation, a trend, and so on and so forth. Let's draw some trend lines really quickly. You can see I have the 89 EMA on my charts, as you've seen in my videos, and this is what I use for my trend line. But we know that oftentimes traders will draw trend lines and they'll connect swings to swings. And again, this is what I mean by loosely. So here's a loosely drawn trend line, traders, and I've just connected some of the swing highs in this series of lower highs. And there are strategies that simply say, once this trend line is broken, when price breaks above and closes above, that is indeed the change of the trend, and you would be getting long right here. And if this is your trading time frame, again, we're looking at our weekly chart, that might be your strategy. I would simply wait for this cross to happen right here on the weekly chart and then drill down to a trading time frame and take advantage of this trade much earlier. Let's take a look. From this swing low to this cross is almost, well, it's about 1,200 pips. So I like to get in on the action a little sooner than that. Let's go to our daily chart. I'm going to get rid of this vertical line. All right, back to our daily chart here, traders. Another strategy might be, if you were a breakout trader, is we could draw a horizontal trend line here and say price is in consolidation, and we pull this line down to our lowest low and say when price breaks below and closes below this particular level of price, we have a breakout trade and we would get short there. So there are ways that you can define, as I mentioned earlier, you can redefine your trend lines. Perhaps a strategy might say that with bullish divergence right here and a close above this trend line, we can get into this trade early. I actually noted this bullish divergence a while back and took advantage of one of these buy trades on a much smaller time frame. And when you look at the higher time frames, the value they provide, that's a 229 pip trade, and I'm not going to sit here and pretend that I would get all of those 200 pips, but I'm pretty sure I can pull 50 or 60 out of that on a much smaller time frame. So that's the value of looking at the higher time frames and understanding higher time frame trends. Let's go to a 4-hour chart, traders, and see if these lines appear. Okay, so here's our 4-hour chart. I'm going to zoom out. Okay, now on our 4-hour chart, look at how many additional sell signals. If we determine that we were a seller only after our daily rotation, let's go back to our daily chart real quick, traders. I'm going to put a line where the rotation took place on the daily chart. And now let's go to our 4-hour chart. Okay, traders, here we are back on our 4-hour chart, and I've tried to zoom out so that we can see this price action, but this line represents the bearish rotation on our daily chart. And if you recall, we were in a downtrend. So every one of these trading signals, Every one of these rotations and first strike and trend line rejection trades on our 4-hour chart is in confluence with the downward trend on our daily chart. If I was going to get long here, if there was a divergence or a counter trend trade here, I would make sure to adjust my position sizing and profit targets and stops based on the fact that the higher time frame is exhibiting a very strong downtrend. And look at, in the course of that time, if the 4-hour chart, if I'm a swing trader trading on a 4-hour chart, look in the course of that time, that's from October 31st all the way to January 13th. So November, December, 3 months, I had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Let's just say 10 trades. Just simply following a rule set that says my RSI crossing my trade signal line in a sell zone. All trading in the direction of the higher time frame trend. And all confirmed, if the 4-hour time frame was my trading time frame, by the fact that my trend line has stayed black almost the entire time. I had a little bull rotation here, but look, all the way down, a little bull rotation here. And the beauty of trading with the higher time frame traders is if I determine that I'm a seller only, then I can ignore all the buy signals because I'm looking to be a seller only. I've determined that on my higher time frame. I'm taking sells only on my trading time frame. So I virtually eliminated all buy trades. So I can put an alarm or an alert on my chart, and when that goes off, if it says buy, I eliminate the trade until my higher time frame has made a bullish rotation, and now I look to be a buyer only on my trading time frame. I hope you're beginning to understand this, traders. I'm trying to illustrate how simple it is to be on the right side of the market. And again, traders, using this 89 exponential moving average visually for me gives me so much more acuity. So all I have to do is click on the daily. If my trend line is black, then on my trading time frame, so I can say I can develop my conditional thought process. If my EMA is black on the daily chart, then on my trading time frame, I am a seller only. Period. I've just eliminated all the buy signals. I'm emphasizing this primarily to beginning traders. Once you have a lot more training, you've studied market structure, you have a lot more practice, you'll begin to recognize more trading opportunities, what I would consider a more intermediate trading strategy, where you can trade a lot of these bounces or retraces. Once you get familiar using Fibonacci, when you're a little more efficient, recognizing and taking a look at divergences and so on and so forth. But as a trend trader, let's assume we are not counter trend traders at all. As a trend trader, it is so simple to look at a higher time frame and say, if the line is black, then I'm a seller only. If the line is gray, then I'm a buyer only. And you've just eliminated a tremendous amount of confusion and conflict and anxiety. Do you have the patience, though, to wait for a signal? That is the biggest challenge facing trend traders. And have you set your stops and targets in a place after doing your back testing that allows the market to bounce up a little bit? It is extremely difficult for many of you to suffer any type of a drawdown. And I'll tell you this, if you're on a 4-hour chart and you can't suffer a 150 pip drawdown during a swing trade, you can't be swing trading. Depending on your strategy, your average drawdown could be between 100 and 200 pips. You've got to be able to look at that drawdown and not be emotionally invested. Not only does it take patience to wait and then recognize and then participate in the trend, but you have to remember that within that trend, there are dynamic swings that can take you, and depending on your trading time frame, between 50 to 250 pips. And I've said this over and over again, traders, you have to develop a trade plan and a trade system that meets your personality. Traders, I think there are some distinct advantages being a trend trader. And one of the main ones is if you're trading in the direction of the overall market sentiment, you're not swimming against the current. You're taking advantage of momentum created by the collective amount of traders in the market who are saying, price is too high, we're going to drive it lower and lower and lower, or price is too low, we're going to force a rally and continue to push prices up. You're letting the collective emotion of traders dictate which direction you're going to trade, and it's so much easier to swim with the current versus swimming against it. And as I think I've just demonstrated, traders, with our 89 exponential moving average, it's very simple to determine the direction of the market and then make that a useful part of our trading strategy so that we can take advantage of the overall market sentiment and get involved in opportunities where the market's pushing a direction that's totally obvious that we're not going to have to fight against. I feel as though if you can determine the market direction and you're on the right side of the market, there is a much higher probability of achieving profit targets when we're trading in the direction of the trend. And I mentioned earlier, traders, when I was talking about counter trend trading, there are additional strategies that we can take advantage of when we become good at identifying the trend and when the trend is changing or losing momentum. Once you beginning traders begin to understand some of these more intermediate concepts, you can trade the market within a trend in both directions. You can trade with the trend, and then you can take advantage of some counter trend divergence trading once you fully understand some of these additional tools that we've touched on in some of these other videos. We have candle patterns, divergence, and of course in this video we discussed the concept of a rotation, and that is when price breaks above and closes above our 89 EMA trend line. That is our bullish rotation. And that is the definition for me in my trade plan and trade system of a trend change. And then, of course, a bearish rotation when price breaks below and closes below our trend line. Again, the definition for me of a trend change to the downside. The other thing we have to recognize as trend traders is that there are larger moves and higher profit potential in trend trading with the trend of the higher time frames. Well, why is that? Well, of course, it takes longer for the trends to change during the higher time frames. And so if we can recognize a strong and solid trend in a higher time frame and then move down to our trading time frame, that's going to provide multiple obvious and easy to take advantage of opportunities while we're trading in the direction of that higher time frame trend. And as I mentioned at the very beginning of this video, traders, trends are created by the dynamic swings, the swing highs and lows, of price action, and those are just really our old friends support and resistance. So that's why trend trading is part of market structure. The trend is in fact created by levels of support and resistance. And last but not least, traders, oftentimes people ask me why I use an 89 EMA. Well, if you go back to our second video on Fibonacci, you'll notice that at the 55, the number 55 in the Fibonacci sequence, the consistent ratio of the 1618 and the 618 starts to manifest itself in all the numbers from 55 and higher. So if you're using a 55 EMA or an 89 EMA, you're working with a consistent ratio in the Fibonacci sequence of the 1618 and the 618. And so it only makes sense to have a moving average with the period set to a Fibonacci level. I particularly like the 89 EMA, traders, because I think it serves a dual purpose. It's a short enough period where you can take advantage of some of the smaller moves and smaller rotations, and it's a long enough period that also can get you into the longer rotations and longer periods and longer trends. So that's just something I've observed, and I just happen to like the 89 EMA. So traders, we'll continue our market structure series until we run out of things to talk about. I think this is going to be somewhat of a long series, but I think there's some valuable information here, giving you some more insights as to how I trade, other professional traders trade that use these same tools. And I apologize for the length of this video. I like to keep these under 20 minutes. I think it's more important that we touch base on the critical elements of these discussions rather than be too concerned about the time. I still think you'll find this information valuable, even though we did run a little bit long in this video. Great to have you back here at the Pro Trader Network, traders. As always, let's stay focused, follow our rules. We'll see you next time.